Hey guys, welcome to another lecture on our YouTube channel. If you are new here, I am pleased to welcome you and I promise you that I will keep pushing out valuable content to ensure that you are equipped with the knowledge you need to navigate this market. Today's lecture will be on aligning higher time frame key levels for execution. And I promise you this one topic, once it clicks, will change how accurately you read the market and how you pull the trigger on your interest. Please ensure to watch to the end to get the value you're looking for. Let's dive into the lecture. Let's start with the foundation, higher time frame or time frame hierarchy. Okay. Here's a truth most traders don't want to hear. If you don't have a plan before you enter a trade, you are not executing, you are just gambling. And that's exactly what wrecks a trader's psychology. Not the loss itself, but the fact that they had no plan to begin with. So today we are going to be building that plan on three pillars, which are the bias, the context, and your execution. Bias is simply answering the question, are you bullish or bearish? And what target are you aiming for either side of your bias? Context simply means what conditions do you want to see met before you execute? And execution, which is the easiest part, is simply looking for the final piece of confirmation before clicking the button. Now, I want to be clear. This is not the only way to align timeframes. This is my framework. Personally, I run daily 1 hour, 15 minutes, or the 5 minutes for execution. Okay. But here's the key concept to hold on to. Price is fractal, meaning that it behaves the same way on every time frame. The same patterns that show up on the daily chart also show up on the 5 minute chart. So it's not about which exact time frame you pick. It's about knowing what you're looking for the moment you look at any of them. So if you're looking at the weekly time frame, you might want to use the 4 hour for context and the 1 hour for execution. If you're looking at the daily time frame, you might want to look at the 1 hour, 30 minutes for context, 15 minutes, 5 minutes, or 3 minutes for execution. If you're looking at the 4 hour for bias, you want to be looking at the 1 hour, 30 or 15 minutes for your context, and the 15 minutes, 5 minutes, 3 minutes for your execution. If you're forming a bias on the 1 hour time frame, you want to build your context on 15 minutes or the 5 minutes and then execute on the 5 or the 3 minutes. If you are building your bias on the 30 minutes or forming a bias on 10 minutes, you want to build your context on 15 or 5 minutes and then your execution on the 5 or 3 minutes. And the same for 15 minutes bias, 5 or 3 minutes context, a minute or 30 seconds for execution. For this lecture, we are narrowing our focus to two key levels, which are old highs and old lows, and the fair value gaps. Okay, so I have a video explaining this in details with the PDRA video, but we're attaching it today to your screen. So just click it after the video to go watch it. Okay, looking at this image, right? Price takes out an old low first. So you see price sweeps this old low, okay, close above it, all right, creating an expansion signature, right, or creating a reversal signature where we anticipate an expansion, okay, and then price expands, gets to this high and begin to pull back, okay. This pullback is what builds this range from this range high to this range low, and you want to understand ranges if you're going to be utilizing what we're going to be teaching all throughout this session, okay. So basically, the PDRAs we're looking at, or the key levels we're looking at on the higher time frame, is the highs and the lows. Okay, the highs and the lows helps us frame our bias, while fair value gaps help us um, build a context for a continuation, right, to the target we are looking at, right. So the highs and lows are what frame our bias. They tell us the bigger picture of where price wants to go. The gaps, they represent internal range liquidity, which are inefficiencies price retraces to mitigate. And this helps build a solid bias conviction when used on the higher time frame, and for continuation when we're utilizing gaps on the lower time frame. Okay, so we're going to be looking at how these highs and lows and gaps interact, right? And that's where we're going to jump into the next section of this lecture. So we have in the first image here external range liquidity to internal range liquidity. Okay, so we have price putting up these consecutive bullish candles, and then we have a reversal signature here where price sweeps the previous candles high and closes below. Okay, then we see this retracement, and then price expands into where this low. And what is this low? At internal range liquidity. Okay, so whenever we're on the market, whenever we're interacting with the market, the questions we should be asking is, are we interacting with an external range liquidity, or are we interacting with an internal range liquidity? If we are interacting with an internal range liquidity, our focus would be what internal range liquidity can we target. Okay, so that's what we have in this first example. Price interact with an external range liquidity. Now the focus is what internal range liquidity can we target. Then we have this situation where price, takes out an external range liquidity and then expands high to take out an external. So this is external to external, right? External to external. Okay. But before price does this, you can see that we have internal range liquidities resting at these gaps. I did not highlight it so that you could train your eyes to see it. Okay. Now we want to see how price reacts to these gaps. If price reacts to this gap and frame a reversal signature, then we could see price expand to take out this external range liquidity. And that's what we have here, where we have price interact with an internal range liquidity, frame a reversal signature, and we have price expand to take out external range liquidity. We see that happen here as well. Okay, so we have the sequence. That's the next thing we're going to be talking about, this sequence. So the first thing you want to be identifying is which higher time frame key level are we interacting with? Are we interacting with a higher time frame external range liquidity, which could be a high or a low, right? Going back to the previous slide, it could be a high or a low, right? And if we are interacting with an external range liquidity, you'll be asking what internal range liquidities are we targeting? Okay, so on the higher time frame, what we are looking at is what high or low are we interacting with. That is what you should be paying attention to on the higher time frame. All right. The second thing is building a context, and you build your context when you've understood internal range liquidities to external range liquidities, or external range to internal range, or external to external. All right. Yeah, the question is still the same with the buyers, right? But we are dealing with bias confirmation here. What we are dealing with when we're talking about context, we are dealing with bias confirmation. If you framed a bias on the higher time frame, we use the second time frame to build a context that aligns with the bias we've already framed on the higher time frame. All right. Here, our bias is confirmed by price interacting with key swing lows and highs for reversals, or simply interacting with gaps for continuations. Okay, you want to be interacting when key candle closure criteria has been met. Okay, so we have this image here again, going back to this image here. So you are bearish on the day and price has taken out an external range liquidity already. Remember, you are bearish, which means you framed your bias on the higher time frame already. Okay, and you're basically from your bias from paying attention to candle closures. So if you see a pattern like this where price takes out a previous day's high and close below it, we're already framing a bias for an expansion the next day to the downside. All right. Now, after seeing that on the daily time frame, you drop down to your mid time frame, which is the hourly time frame. For me, I use the hourly time frame. It could be for you the 4 hour or the 15 minutes, whatever time frame suits your personality. Okay. Now, what do you want to see? You want to see the same signature you saw on the daily time frame occur on the hourly time frame. Now, what that does is that it builds a context for you, right? And the context validates your bias. So once you see this happen, a reversal signature happen on the hourly time frame, which is classified by price sweeping and external range liquidity and closing below it, or price sweeping and internal range liquidity and closing below it. So it could be an external to internal range liquidity framework or an internal range to external range liquidity framework. Okay, so once you've built this context on the lower time frame, which is your context time frame, right? The next thing you look at is execution. And this is the most easiest part. Here you just look for a stop rate, a CISD, and your target. Me personally, I use the 3R. I use 3R for my target. Okay. So, but before we drop down to lower time frame, we must have confirmed our bias and context for execution. What do we do on the lower time frame? We look for swing lows or highs formation, which is specified by a stop rate, followed by CISD, and then we'll get our entry and set our target. Like I said, I personally use 3 hours, so you can apply that or just do what works for you. Okay. So let's using this, having this framework at the back of your mind, let's drop down to examples to explain or give further clarity to what we've been discussing so far. The first example is on NQ, and this data was gotten from Thursday, 11th of June, 2026. So you could go back and look at this, right? The first thing you want to do, like we said, is framing a bias. And we use key swing lows and highs to frame a bias. So, and we do that on the higher time frame. For me, like I said, I use the daily, the 1 hour, and the 15 minutes or 5 minutes for execution. This helps me narrow my focus to specific times and signatures I want to see in the market and eliminates the ambiguity with looking at so many time frames all at once. Okay. So on a daily time frame, you want to frame your bias, right? And on Wednesday, we had price sweep this key, this relevant low, right? And then we had price put up an SMT with ES. This is the ES framework. Price sweeping this low. And we could see as well that we are interacting inside of this range candle, the range high and the range low. So as soon as price does this and closes above, we're not interacting with this candle yet. Okay, in this case, we're not interacting with this candle because this candle, this first expansion candle is classified as the candle 2 expansion candle, which is the C2 candle. Okay, so we are not interacting with the C2 candle here. Now, as soon as this happens, we are anticipating an expansion on Thursday. Okay, so what do we want to see during the expansion? To confirm our expansion, to confirm our bias for the day, we want to see the hourly time frame build a context to validate our bias. All right. Now, on the hourly time frame, we want to see the same signature we saw on the daily time frame. We want to see it on the hourly time frame. And what is that signature? We want to see price interacting with a key swing low or a swing high or internal range liquidity, which are gaps. As you can see here, we have this fair value gap here, right? And then we had price interact with this fair value gap already. On ES, price took out this low, but on NQ, it's an SMT. Okay, so an SMT put together with price interacting with this candle here is what framed this C2 expansion. Okay, so you could trade this, and this is you looking to trade the 12 o'clock expansion because this last candle was 11 o'clock C2 candle formation. Okay, so you're looking to trade the 12 o'clock continuation or expansion to take out external rich liquidities written above this high. All right, so this is an internal rich liquidity to an external rich liquidity. Okay, so if you missed this, okay, after you've had this contest, right, this is where you drop down to the 5 minutes time frame for execution. And what do you want to see in 5 minutes time frame? We want to see a stop rate. So we see price put in these consecutive bullish candles, sweep this low. This is the stop rate we're looking for. Then we had this candle expand aggressively for a CISD. Now you don't want to be chasing price here. So what do? You wait for the next candle to open. And the next candle that opened was a 13 o'clock candle, right? And 13 o'clock opened, create this swing low. So this is internal range liquidity, right? Interact with internal liquidity, fair value gap, this big imbalance formed here. And as soon as price sweeps this low, stop trade, close above this candle for a CISD. That is our entry, set our limit entry here. Stop loss below these lows, and we aim for your 3R. And this is the first example we are dealing with. You can see how this makes your execution easy and better, right? When you're looking for key signatures in the market that aligns with your bias. All right. So the next example we're going to be looking at is ES Tuesday, 23rd of June, 2026. All right. So here we have on the daily time frame the same signature price interacting with this high, a key swing high, putting up an SMT with NQ here, right? And we've identified this candle as the range we are dealing with. So we're anticipating price to expand to take out this low. But this was confirmed by how this daily candle closed. It manipulated this high and closed below this high, creating a framework for expansion on the next day, right? Which is Tuesday. So this was Monday. So we're anticipating Tuesday's expansion into these lows here. All right. Now on Tuesday, what do we want to see on the hourly time frame? We want to build a context that validates our bias. And what do we have here? We have price put in this C2 candle formation. The first C2 candle is here, right? Price ranges here, fails to take out this low, right? So we wait for more information. Price creates this candle, right? And then we see this beautiful C2 closure, right? This closure validates that we could anticipate expansion into this internal range liquidities resting below this low and internal range liquidities resting below this low. So we have external to internal, internal to internal, and then we'll look for how price could take out this low, which is an external range liquidity. Okay, so this was the 12 o'clock candle. So we are expecting, okay, this was a 13 o'clock candle. So we're expecting expansion, a follow through. Okay, so if you had missed interacting with this C2 candle, which I don't advise people to do, I always advise that you stick to the candle 3 expansion unless you have enough experience to interact with the candle 2 manipulation. But this is, to me, this is a C2 expansion candle, and this is the kind of candles I want to be interacting with. This is a C2 manipulation candle. This is a C2 expansion candle. And the C2 expansion candle is the kind of candles I want to be interacting with, right? Well, if you don't have the experience for this, you wait for the next candle to expand lower. So once we have this framework, this context on the hourly time frame, what do? We drop down to the 5 minutes for our execution. And what do we want to see on the 5 minutes? A stop rate, price take out the liquidity resting above this high, right? Mitigate this gap, which is what? Internal range liquidity. So once we have this, what is our target? This internal range or external range liquidity. This external or internal? This is internal range liquidity. Okay, because we are still inside of this range high to the range low. Okay, so we have internal to internal, right? So as soon as price manipulates this high, closed below it, and we have this next candle from the CISD, you could take your entry from here. You stop loss above these highs, target the 3R, and you're done, right? So if you didn't interact with the 13 o'clock expansion, that was another opportunity for you to expand to interact with the 14 o'clock candle expansion. And that is why I made this this is the 5 minutes outlook of this price action here. Okay, so this new swing high is the 14 o'clock open. So we have 14 o'clock open here, right? We traces into this 5 minutes gap, which is an internal range liquidity, create this swing low, closes below this candle here to confirm a reversal candle, and then we wait for a CISD. As soon as price gives us that CISD here, we enter our stop loss above these highs, right, to protect our capital while we're on the trade, and then target of 3R. And that is basically the same thing, right? We're just doing the same thing over and over again. And repetition is what builds mastery. Okay. So credit to T-Trades. This is his fractal model, and it has helped me improve my trading significantly. And that is why I'm teaching it again. Okay, so we have the next example. This is Tuesday, 7th of July, 2026. So this is more recent than the previous two examples. Okay, so first thing we want to do is to frame our daily bias. And you can see we're interacting with this range high and this range low. Okay, already there's an SMT that have been framed here as well. Okay, so price interacting with this high and closing below. This is the Monday candle, Monday daily candle, interacting with this high and closing below it, right? Creates a framework or builds a framework for an expansion to the downside on Tuesday. Okay, so with this bearish bias, we go down to the hour to the time frame to build context that validates our bias. And what do we want to see on the hourly time frame? We want to see the same framework with the bias, right? So we see this 8 o'clock candle open up, flips this key swing low here, right? Frames an SMT here, right? So now we are anticipating the 9 o'clock expansion to take out the resting liquidities, resting above this external range liquidities, this external range low, sorry. So we are expecting price to expand on the 9 o'clock. So we are treating the 9 o'clock expansion candle as the candle we want to be interacting with as price expands to take out liquidities resting below these lows and other possible lows, right? Today, to your left. So we have the 5 minute execution. What do you want to see? The same thing. So we have this here. This is 9 o'clock opens, put up this swing high, right? Interacting with this fair value gap, okay, and then closes below this um this bullish candle to frame a CISD. All right. So my entry here. You might be wondering why didn't I put my stop loss here? I didn't do that because this is pre 930, right? And then I also discovered that we have a gap here. Price could actually seek to utilize again, which is internal range liquidity. Okay, so me adjusting my stop loss to this absolute high would have been much better, and it's I'm not risking so much even if I do. Okay, so um my risk points are not so much even if I do. So that is why I was comfortable placing my stop loss above this high. Okay, and then target of 3R, and we had this beautiful price action. So we see is the beautiful thing about this model is it is repeatable. The same thing you want to see on daily is the same thing you want to see on the hourly, and that gives you a better framework to interact or execute on the 5 minutes or 15 minutes, as your case may be. So we have the last example, which is NQ Monday, 23rd of July, 2026. Oh, sorry, this should be June. Sorry, this should be June. And I think it should be 3rd of June. So I got the date wrong, but you can go down to your trading view and investigate this. All right. So we have the daily bias, the same signature, price interacting with a relevant key low, key swing low, and closing above it, frames that okay, we could be expecting an expansion. So this is you expecting to trade the C2, C3 expansion. Okay. After framing a bias, so this bias is what does it mean? You are simply looking to go long the next day. That's all you're looking forward to do on the next day. So on the 1 hour time frame, you build a context to validate your bias. And what you want to see, you want to see the same signature, the same signature. All right. So I also got the time wrong. This is 10 o'clock. So it's 10 o'clock C2 candle formation where price swept this low. There's an SMT with AS on this to add more confluence, right? And as soon as this 10 o'clock candle closed, right, you can see that we put up a large expansive move 10 o'clock. So you don't want to be chasing price. So you wait for the 11 o'clock expansion. All right. So this time is not correct. It's supposed to be 11 o'clock and it's supposed to be 3rd of June, July. So please take note of that. Now you drop down to the 15 to 5 minutes for execution. So we sell price, manipulate this low, and then expand high, right? Creating the CISD. So you were wondering, why didn't I do the same thing I did on the previous candle example on this as well, right? There's an SMT here to validate this setup. And price was already interacting with the 15-minute gap. So I will leave you to go and investigate that as well, right? So take that note down to investigate this day's price action. This swing low that was formed here was interacting with the 15-minute gap. So I saw no need for price to trade into this 5-minute gap since we are utilizing a much higher time frame gap for the trade. Okay, so as soon as price closed above these two consecutive bearish candles, that framed what a CISD. Our entry 3R, target below and stop loss below these lows 3R, and we're off the market. Okay, so I hope this video has brought clarity to you, right? I hope the video has brought clarity to you and has simplified what you should look for in the market when you come into the markets every day. So what this will help you do is that it will help you identify the days when you shouldn't be in the market. This is what this will help you build, which help you build context or build a framework for days you shouldn't be interacting with the market. Okay, so you want to have these three foundations aligned: your bias, content, execution, for you to build a solid trade plan going into the day. All right. So we have come to the end of this video, and I want to say thank you for watching to the end. Please subscribe to my YouTube channel, right? Join my Telegram group where I give live analysis of my market and everything. So thank you for watching.